In this video, we're going to talk about Charlie Munger Stock Investing advice for beginners. Hey, before starting, please do like the video and subscribe to our channel for future updates. Those of you who've had a good fortune to be present at a Berkshire Hathaway NYSE BRK-A or Berkshire Hathaway BRK-B annual shareholder meeting have definitely heard Charlie Munger say, "I have nothing to add." In point of fact, the individual has a good deal more to contribute. We are fortunate that Munger shares his ideas on investments with us almost as openly as his close friend Warren Buffett does. Even the most unskilled investors could profit from Munger's 10-step checklist that is presented in his must-read book, Poor Charlie's Almanac. The checklist is included in the book. Number 14, the big money is not in the buying or selling, but in the waiting. Charlie Munger is a long-term investor. Buying great businesses and holding them for many years is the foundation of his approach and Berkshire's tremendous success. Number 13, you must force yourself to consider opposing arguments, especially when they challenge your best-loved ideas. Even as you strive to hold your stocks for the long term, you must remain vigilant to new threats that could derail your investments. Rather than seek out evidence confirming that your investment thesis is correct, as many investors are prone to do, you'll be better served by looking for evidence that you're wrong. Number 12, quickly identify mistakes and take action. If you do come across information that suggests your investment thesis is incorrect, your best course of action is likely to sell sooner rather than later. This is true regardless of whether you are up or down on the position. It may not be easy, but Munger believes you should sell and invest the capital in a better idea. Number 11, someone will always be getting rich faster than you. This is not a tragedy. Many investors make the mistake of trying to keep up with the Joneses. This can lead them to take on too much risk, often in the form of leverage. This in turn has led to countless calamities, many of which could have been avoided. Number 10, stay focused. Keep things straightforward and don't forget the goal you had established for yourself. When we fixate on little and irrelevant details, we frequently fail to recognize significant and decisive elements. But if we keep things straightforward, we'll be able to zero in on what truly matters, namely buying solid businesses at reasonable prices and maintaining them in our portfolios until they reach their true value. Although Charlie Munger is frequently eclipsed by his more famous business colleague, you shouldn't believe that this is in any way indicative of Munger's own level of brilliance. He has, without a question, served as a guiding light for Buffett himself, and by all measures, he ought to be remembered as one of the greatest investors in the history of the world. Number 9, be ready for change. Accept unremovable complexity. Achieving success in investing needs us to be open to unavoidable shifts. For decades, Munger and Buffett were adamantly opposed to investing in railroads, but as the world around them evolved, they abandoned their previous viewpoints and ended up investing billions of dollars. The world around us will not always correspond to our preferences and biases, and there will be occasions when even our most well-conceived beliefs will be proven to be wrong. If you aren't willing to adapt your business strategy to meet the demands of a shifting market, you can find yourself waging a battle you can't win. Number 8, be decisive. When the right conditions are present, you should behave in a way that demonstrates both conviction and decisiveness. This also relates to the concept of not going along with the crowd. When other people are happy, you should be afraid. And the opposite is also true. You shouldn't let feelings of other people sway you. The masses of the market should assist you to identify opportunities when they aren't there, not lead you down the same route to mediocrity that they look. Number 7, have patience. Fight against the need to act that comes with being human. It was Munger himself who put it best when he remarked, "Half of Warren's time is spent sitting on his ass and reading. The other half of Warren's time is spent talking on the phone or in person to a highly gifted individual who he trusts and trusts him." Even though it may be tempting to trade in and out of the market frequently, the only way to build a meaningful fortune is to make substantial investments in high-quality businesses and hold on to them eternally. When you've finished with that, you should look for a new pastime. You won't accomplish much by devoting your entire day to monitoring stock tickers. Number 6, allocate assets wisely. The most important responsibility of an investor is to distribute their money effectively. In the beginning of Munger's investment partnership, he only had a very limited number of stocks. He only had a very limited number of stocks under his control. When profitable opportunities presented themselves, he invested a large amount of wealth in pursuing them. Otherwise, he did nothing but bask in the California heat. The amount of capital that you put into each of your investments should have a direct bearing on how appealing that investment is. When you come across a fantastic investing opportunity, you shouldn't be hesitant to place a significant wager on it. Number 5, analyze rigorously. Make use of thorough checklists to cut down on the number of mistakes and omissions. The data don't lie, as they say. When doing research on investments, Buffett and Munger prefer to make an estimate of the value of security first before looking at its price. They are not addicted to the stock market and instead are businessmen. They don't waste their time and energy on complicated economic projections or market timing strategies. Rather, they concentrate on the worth of individual companies. Although Munger possesses an extraordinary level of intelligence, the analytical rigor that underpins his investing choices is centered on simplicity rather than complexity. Number 4, have intellectual humility. The first step toward becoming wise is being honest about what you don't know. The fact that Berkshire's management never venture outside of their comfort zones is one of the factors that may be the most important to the company's success. When it comes to investing, having a crystal clear picture of how the company will function in the years to come is the single most important factor. If you have trouble understanding what the company does now, you might as well be tossing darts. Even if businesses like Google and Boston Scientific are unquestionably titans in their own right in the present day, it is possible that in 5 to 10 years from now they may appear very different. Number 3, prepare ahead. Working hard, and working some more while keeping your fingers crossed for any breakthroughs is the only way to succeed. It shouldn't come as a surprise to you that the types of investments that are often covered in the news aren't necessarily the greatest ones. There are uncut diamonds out there somewhere, but it's going to take some work to unearth them. Even though he may only come up with a few potential candidates each year, Buffett reads thousands of annual reports in order to foster ideas. Munger encourages his followers to maintain a curious attitude in practically every aspect of life. You won't have an issue keeping motivated if you make it a habit to always ask yourself why in all that you do. Number 2, be autonomous. Only in fables and legends are rulers ever made aware of their lack of clothing, because stockbrokers are frequently paid for their activity rather than their successful investments. It is of the utmost importance to ensure that you are acting in accordance with your moral convictions. Although it could make sense to pursue the viewpoints of others, successful investors such as Munger and Buffett more often achieve their goals by going against the grain. When they were first made, most people didn't pay much attention to significant Berkshire investments like Coca-Cola and more recently PetroChina. Both of these companies are now household names. And number 1, measure risk. The assessment of risk, in particular reputational risk, needs to come first in any and all analyses of investment opportunities. It is of utmost importance to have the realization that there will be times when the returns on your investments are not what you had hoped for. Don't put yourself in a position to fail completely in the first place if you want to keep your investment safe. Steps in the correct way include giving oneself a large margin of safety, avoiding people of doubtful character, and only engaging in risky behavior when one can be certain that one will be rewarded sufficiently for taking the risk. Companies such as Chipotle may have absolutely bright prospects, yet when their shares are priced for perfection, it is possible that they will prove to be too hazardous for astute investors. So what'd you like most about our video here? Let us know in the comment box below, and please do like the video and subscribe to our channel for future updates.